Ever stop to think what actually goes into the price of, say, your favorite fizzy drink, or maybe that luxury car you've been looking at? Because beyond just the making of it, there's this huge force, right? Taxes. And in India, well, that force just got a pretty big upgrade. Today, we're taking a deep dive into, well, a really monumental shift in India's tax landscape. We're talking about the GST Council's approval of a new highest tax rate, 40% on specific goods. It's part of what people are calling GST 2.0. And look, this is much more than just a minor tweak. It feels like a comprehensive overhaul, and it's got far-reaching implications. We'll be drawing on reports from the Economic Times and also the GST Rates in India 2025 guide. Our mission really is to unpack these changes, understand what they mean for the economy, for different industries, and maybe most importantly for you as a consumer. So get ready to understand not just what's changed, but why it actually matters.
Okay, so let's try and unpack this. The talk of major GST reforms, it's been buzzing for a little while now. Even Prime Minister Narendra Modi flagged it, didn't he, in his Independence Day speech?
August 15th, 2025. He called it a Diwali gift. And now, well, it seems to be becoming a reality. The GST Council met September 3rd and 4th, 2025 in New Delhi. They were finalizing these reforms. And the expectation is they'll roll out pretty soon, maybe September 22nd, or definitely by Diwali this year. So the new structure, it simplifies things quite a bit, down to just two slabs, 5% and 18%. But the really groundbreaking element, the one grabbing headlines, is this new highest rate, 40%. It's specifically reserved for what they're calling sin and luxury items. This replaces the old 28% top slab.
Yeah, and the philosophy behind that 40% rate, it's quite telling, isn't it? A sin tax is, well, basically an excise duty. It's slapped on goods that are seen as harmful or maybe socially costly. And it really serves two purposes. One, discourage usage. Two, generate extra cash for public welfare. What's really interesting here, though, is the government's expectation. They seem to anticipate higher revenues, perhaps more so than lower consumption. And that's because taxes on these kinds of sin goods are often what economists call highly price inelastic.
Meaning people buy them anyway.
Pretty much. Consumers, especially, those with an addiction, they tend to keep buying even when prices go up. Just think about this. Cigarette consumption alone is estimated to drain over 1% of the country's GDP. That's huge.
Wow.
So the revenue collected, it's often earmarked directly for welfare programs, which kind of reinforces its role beyond just trying to get people to stop.
Okay, so it's not just a random number then. It's a deliberate policy choice. Public health plus revenue generation. But when we talk about this new 40% bracket, what exactly is the GST Council defining as, sin or luxury? What falls into that category?
Ah, yes. That's the crucial question, isn't it? The specific list of goods really reveals a lot about the government's thinking and priorities.
Absolutely. So the council has been pretty specific about what gets hit with this new 40% slab. First up, and maybe not a huge surprise, tobacco and related products. So we're talking pan masala, gutka, cigarettes, chewing tobacco like Zarda, unmanufactured tobacco, beidi, scented tobacco, cigars, cheroots, cigarillos, the whole lot. Now, there's an important detail here, a nuance. Tobacco products will actually stay on their current system, that's GST plus this cess, until the compensation cess loans are fully paid off. Only after that happens will they move into the 40% slab. Okay, you mentioned cess. Could you quickly explain what that means for listeners, especially how it affects the total tax on something like tobacco?
Sure. So a cess is basically an extra levy. Think of it as a tax on top of the regular GST rate. And it's usually collected for a very specific purpose or fund. In this case, the compensation cess was originally meant to help states cover any revenue shortfall after GST came in.
Right.
So while the base GST rate might be 28% or potentially 40% in the future, the cess itself can be really substantial. It varies wildly. I mean, from 1% to over 200% on certain items.
Wow, 200%.
Yes. So for tobacco, the total tax burden when you combine the GST and the cess is actually expected to stay about the same, around 88%.
I see.
Which means for the consumer, the immediate price shock from this specific move to 40% might not be huge, but it's part of an already very heavy tax structure.
That definitely adds important context. Okay, so beyond tobacco, what else is in the 40% club? We're also seeing sugary and flavored drinks targeted. So that's your aerated waters with added sugar, carbonated drinks, caffeinated ones, energy drinks.
Basically the fizzy drinks aisle.
Pretty much.
Yeah.
Then we have luxury vehicles. High-end cars, they specify engines over 1,200 cc petrol, 1,500 cc diesel, SUVs, big motorbikes, even yachts.
Right.
And finally, junk foods. Things like processed items high in sugar, salt, or trans fats, plus some other imported or dutiable personal use items.
Looking at that list, you can really see a calculated strategy emerging. It's not just hitting the obvious sin items for purely health reasons. They're clearly targeting goods known for that price inelasticity we talked about to really maximize revenue.
Right, the things people might keep buying.
Exactly. And including luxury vehicles, imported goods, it clearly signals government priorities on, well, both public health and luxury consumption. It feels like a very deliberate selection of targets, aiming for a big revenue impact. Which, interestingly, raises another question. What about alcohol? Many people would put that in the sin good category.
That's a really good point. Alcohol often gets lumped in with these types of taxes.
Indeed. But it's crucial to remember, alcohol is still outside the GST system. It continues to be taxed separately by individual states, mainly through state excise duties.
Ah, okay, so GST doesn't touch it.
Not directly, no. So this new 40% slab is really hitting categories that were often already at 28% plus those extra cesses, like many of the drinks or tobacco products. What's not moving into this 40% club, importantly, are things like general consumer durables. Think air conditioners, refrigerators. They were at 28% too.
But they're staying out of this top tier.
Exactly,
Right.
which really underlines how targeted this sin and luxury definition is. It's not just a blanket hike for everything that was in the higher brackets before.
Yeah, it really highlights the specific choices being made here. Think about how many of these things might touch your daily life, or maybe your occasional treats. What really jumps out at you from this list, and how do you think this new rate will actually affect buying habits, especially for people who consume these things regularly?
Okay, so we sort of laid out what's changing and the thinking behind it, but what does this actually mean for the big companies, for the industries involved, and maybe even for global trade? The government seems to be framing this as a comprehensive long-term fix, not just fiddling around the edges. And the timing here is, well, it's really compelling, isn't it? These domestic tax changes are happening right after the Trump administration hit India with those sweeping 50% tariffs on goods. That took effect August 27th, 2025.
Right, that was recent.
And U.S. officials apparently linked it to India, still importing Russian oil and being, quote, intransigent in trade talks. So you have to wonder if the center's move here, overhauling GST, maybe boosting domestic consumption, is partly a strategic response, a way to try and lessen the economic blow from those U.S. tariffs. That's a really critical angle to consider. It suggests this isn't purely about internal finances or health policy. It could very well be a strategic economic move on the international stage. By perhaps trying to strengthen the domestic economy, generate more internal revenue through these higher taxes, India might be trying to build resilience against these external trade pressures.
Makes sense.
It's a fascinating interplay, how domestic policy decisions can be influenced by and respond to global events and relationships.
And as you'd probably expect, this whole thing has definitely kicked up some significant pushback from industries. Concerns are being raised. Take a company like ITC Ltd. Cigarettes are huge for them, right? Over 80% of their net profit. So this new framework is, well, it's a mix of risk and maybe some relief for them. Investors have been nervous about regulatory changes. But one brokerage firm, Jefferies, they seem to think the council focusing on revenue neutrality for tobacco was actually positive. They suggest that overall tax burden, that 88% figure you mentioned, might not change much. But Jefferies also points out a crucial detail. The balance between specific duties, that's a fixed amount per cigarette, and ad valorem duties, which rise with the retail price. That balance is critical, because ad valorem duties tend to reduce a company's pricing power.
Exactly. It impacts their margins and flexibility.
And ITC itself noted in its annual report that heavy taxes have already pushed people towards illicit cigarettes or other tobacco products that are taxed less heavily. So when the government banks on this price inelasticity for more revenue, is there a real risk of just fueling that illicit trade ITC is worried about?
That's the classic policy tightrope, isn't it? And it's where the theory meets the messy reality. While, yes, historical data often shows consumers of these goods are less price sensitive, there's definitely a limit. If you push the legal prices too high, you absolutely create a stronger incentive for black markets to fill the gap.
Right.
ITC's own report is basically saying, look, this is already happening. It's the perennial challenge with sin taxes. They can be effective for revenue and deterrence, sure, but they can also be regressive, hitting lower income groups harder. And they always carry this risk of unintended consequences, like boosting illicit trade. Policymakers constantly have to wrestle with that.
And it's not just the tobacco industry raising concerns.
Yeah.
The beverage industry, speaking through the Indian Beverage Association, IBA, has argued pretty strongly that putting a 40% tax on carbonated soft drinks just discourages innovation and stunts growth. They highlighted a study, I think it was by IR.
Yes, the India Council for Research on International Economic Relations.
Right. And that study apparently showed India's fizzy drinks market, even though it was worth over $18 billion in 2022, is still lagging behind other developing countries like Thailand or the Philippines.
Interesting comparison.
Yeah. So the non-alcoholic drink sector actually lobbied the government to reduce GST on aerated drinks down to 18%. They argued it would spur investment, maybe create like 1.2 lakh jobs by 2030. So you've got this clash, haven't you? Public health aims versus economic growth, job creation arguments. How do you even weigh those competing claims? Can these taxes really hit their behavior goals without causing too much economic drag?
It really throws the core tension into sharp relief. On one side, the government has clear objectives: curb consumption of unhealthy stuff, bring in revenue. On the other, industries are making a valid case about their economic footprint, jobs, investment, growth, and how a very high tax rate could potentially smother that. The real challenge for policymakers is finding that balance point, that sweet spot, if you like, where you advance public health goals, but without crippling an industry, or, and this is crucial, putting an unfair burden on consumers. And let's not forget that point about who pays. There was an ET Prime report highlighting exactly this concern. Raising GST on soft drinks and tobacco tends to hit low and middle income households hardest.
Because it takes a bigger chunk of their budget.
Precisely. So there's an ethical dimension, too. How do you balance broad public health aims against the fact that these taxes can disproportionately affect those with less money?
It really is a complex web, isn't it? It's not just about the price tag at the checkout. You're navigating economic strategy, public health policy, intense industry lobbying, and even global politics all tangled together. Now, while this 40% sin tax is definitely the main event, grabbing all the headlines, this GST 2.0 overhaul is actually broader than that. Remember PM Modi's call earlier about removing the 12% and 28% slabs, merging things into either 5% or 18%.
Yes, the simplification agenda.
Exactly. This seems to be part of that ongoing effort to simplify things, rationalize the tax structure.
Yeah, and that's a key takeaway here. GST isn't static. It's constantly evolving. The council meets regularly. They revise rates, often to fix things like inverted tax structures.
What's that exactly?
That's basically when the tax rate on your inputs, your raw materials, ends up being higher than the tax on the final product you sell.
Ah, okay. So it discourages making things locally.
Precisely. It can put domestic manufacturers at a disadvantage. So the council tries to correct those imbalances. They also adjust rates to give a boost to specific sectors or just to make compliance easier for businesses. So beyond the big 40% news, we've actually seen quite a few other shifts recently. Things aimed at making life-saving treatments more affordable or adjusting rates in new sectors to match how the market's changing.
Can you give us a couple of examples just to illustrate how these other changes are working?
Sure. So on the one hand, you've seen some important items get cheaper tax-wise. For instance, gene therapy for life-threatening diseases. That went from being taxed to completely exempt.
Wow, that's significant.
Definitely. And several key cancer drugs saw their GST rate drop from 12% down to 5%. Things like fortified rice kernel, important for nutrition, also moved from 18% to 5%. Even skills training partners approved by the National Skill Development Corporation are now exempt from 18% GST. That's clearly aimed at boosting workforce skills.
Okay.
On the other side, you see adjustments in newer areas, like used electric vehicles. If a business refurbishes and sells one, the GST is now 18% on their profit margin. That's up from 12%.
Right.
So these tweaks are happening all the time. It shows they're constantly trying to fine-tune the system.
Yeah, these ongoing adjustments really show just how dynamic the tax system is, always trying to adapt, aiming for efficiency, fairness, responding to what the economy and society need. It really is a constant balancing act. So we've taken a pretty deep dive today into India's GST 2.0 changes. We focused a lot on that new 40% and sin tax slab, what it targets, why it's there, that dual purpose of discouraging bad habits while boosting government funds. We also looked at the pretty strong industry reactions, the pushback, and we touched on the wider picture, the continuous reforms happening within GST, and how this all fits into India's broader economic strategy, especially with those global trade pressures.
And as India keeps navigating this really complex landscape, juggling public health, raising revenue, responding to global trade issues, it leaves you wondering, doesn't it? How do you think these tax reforms will actually shape consumer choices in the years ahead? And what about business innovation? Have they struck the right balance here for India's long-term goals? Or will we see more adjustments down the line as the real-world impacts become clearer, maybe facing new challenges, like that potential rise in illicit markets we discussed?
It is a lot to think about, definitely. And it's a conversation that's clearly going to continue and evolve. We really encourage you to keep an eye on how these policies play out and see what the real-world effects are on your own life, perhaps, and certainly on the wider economy.